price of basic metals, energy, and basic foodstuffs are soaring, increasing rapidly. Price bubbles involve irrational behavior by investors drawn to the prospect of quick profits, or you could call it greed. But such manias aren't entirely measurable. There's no magic indicator that flashes bright red when a reasonable investment trend suddenly becomes unreasonable. Instead, you have to look at several different ways to measure bubble behavior. By those measures, the bubble in commodities is forming, but it's not at full froth or speed. Nonetheless, more new signs of commodities mania keep bubbling up. The basic sign is a near vertical rise in prices. If you just look at the way oil has been moving lately, it's almost inconceivable that there is information about the future supply and demand of oil that's driving all this. It cannot be the case that, relative to some weeks ago, we have information that would make the price of oil go up that fast, that significantly. The price of a barrel of light, sweet crude oil has soared 17.4% or more the past 3 weeks. And Wall Street, for one, thinks that the market for commodities is hotter than the market for stocks. Yes, everything is going up. Faster and faster. Every bubble starts with a rational investment thesis, and in this case, it's the roaring economies of India and China. They're growing very fast, whose ferocious appetites for steel, copper, and oil and other metals have been pushing up the prices of raw materials. Improved diet and nutrition in emerging markets, as well as U.S. mandates for biofuel use or ethanol, have driven up the cost of food also. And India and China seem to be in the throes of a wage price inflation cycle. China's inflation rate rose to 8.5% the past 12 months. India's inflation rate rose to a 3.5-year high of 7.6%, and wages in both countries are skyrocketing. As a result, the prices of Chinese imports, long and important method of controlling price inflation here, have started to rise sharply or rapidly. Usually, or normally, taming inflation is a job for a nation's central bankers. They push up interest rates to slow down the economy and cool off demand, theoretically shutting down inflation. But most central banks are doing the exact opposite. China and many of the oil-rich Persian Gulf states, for example, have been buying up dollars, and to do that, they have been creating money. The Saudis and the Chinese have flooded their economies with their own money, says the chief economist for investment bank Northern Trust. And U.S. central bank policy, for now, is aimed at avoiding recession, not taming inflation, even though we have both recession and inflation. So how's that going to work? Anyway, the question then is whether the rush of money into the commodities markets has helped push prices higher than they would be otherwise. If inflation is the root cause of a potential commodities bubble, the cure should be fairly simple, it would seem. Central banks have to raise interest rates to slow economic growth. Already, the futures markets are predicting a quarter-point increase in the Fed funds rate by the end of the year, as the Fed turns its attention from warding off recession to fighting inflation. But here's the catch. Unfortunately, the Fed can't do it alone. The Fed can't control what's happening outside the U.S. As long as the global inflation cycle remains intact, prices will most likely continue to rise. And as long as prices rise, money will continue to pour into commodities, pushing prices yet even higher. Should world central banks act in concert to end the commodities bubble, if indeed it is a bubble, the end may not be very pretty. In the commodities markets, you can make as much money by betting on falling prices as you can by betting on rising prices, if that makes any sense. Theoretically, all commodities traders really want is a clear trend. They don't care whether it's up or down. But nowadays, they don't seem to know which way it's going. And supposedly, because the cure for inflation is a slower economy and higher interest rates, there's always a danger of global recession, or worse yet, global depression. Surging demand for all kinds of goods and things is driving this. Higher prices mean real suffering for the world's poor, who are struggling to cope just to be able to eat their next meal. So, speculation, greed, capitalism, yes, pure greed is also driving this, and the speculation, which is driving up prices, along with surging demand from India and China for all kinds of things: gasoline, metals, meat, more food, all kinds of things. A futures bubble means a transfer of real income from the poor to the rich. If not controlled or unchecked, it could very well have very profound political consequences across the globe, among other things. Jeremiah chapter 6, verse 13. For from the least of them even unto the greatest of them, every one is given to covetousness and greediness, and from the prophet even unto the priest, every one deals falsely. They have healed also the hurt of the daughter of my people, saying, Peace, peace, when there is no peace. Were they ashamed when they had committed abomination? Nay, they were not at all ashamed, neither could they blush. Abomination after abomination. Therefore they shall fall among them that fall, at the time that I visit them. They shall be cast down, saith the Lord